Ladies and gentlemen, welcome to the Ouinex podcast, where I will be your host, talking about the underlying fundamental and macroeconomic factors that drives the value of a market. A big mistake that I see a lot of retail traders make is that they don't look at these underlying macro and fundamental factors that truly drives the value of a market. I'm going to be teaching you how you can master the art of successfully forecasting where price is going to go, how to align your technical rules and your strategy with those underlying fundamental factors that drives a market, increasing the probability of your setups and allowing you to form a really good solid long-term edge. By the end of this, you will have full understanding of how all the regulated institutions and firms around the world submit their live positions to the CFTC every single week, and how those reports are public for us to read and understand what particular markets they are extremely bullish and extremely bearish in, which we can use this information to our advantage to forecast those next big market moves for you to remain long-term consistent and protect your investments and wealth in the market. My name is Jay. I'm a full-time investor and corporate trader. I was mentored by a floor trader on the Chicago Mercantile Exchange, where I will be giving you insight into what a lot of the floor institutional traders look at on the back end of a particular market. I don't do the whole typical Discord communities, live stream trading, and course selling, purely because trading and investing is my pure type of business, and also because of regulation. It's very unethical to our investors who commit a lot of money into the business for us to be sharing our public trades on the internet for everybody to see. Many years back, I used to do the whole typical social media influencer Discord type style, where I did a lot of markups, updates, and live streaming. I've helped many traders and investors over the years reach long-term profitability in finding an edge that suits their lifestyle. On top of that, I have helped hundreds of traders reach their ever first profit splits with their preferred prop firms. The way I've structured this is in a very simple step-by-step presentation slide, where I'm going to go over the most important underlying fundamental factors that drives the value of a market. First is the COT reports, where all of our regulated hedge funds, institutions, and banks have to submit their live trading positions to the CFTC, which is the Commodity Futures Trading Commission, which is a government regulation firm in the United States, every single week to this firm, where these reports are available for public view. This is a law in the United States that has to be in place in order for every single institution to be properly regulated. These reports we can use to our advantage to identify if a certain group of traders, such as the commercial hedge funds, are super bullish or super bearish in a market. Second is the market valuation, where we will value any particular market against the economic powerhouse of the world. Now, that economic powerhouse consists of ultimately three markets: the United States dollar, the United States Treasury bonds, and the gold market. Whenever we see a particular market undervalued or overvalued to this economic powerhouse, we tend to see those larger corrections in price for the market to revalue. Thirdly is our true seasonality cycles. Much like in our human year-to-year lives, we have very repeating cycles and events in our life. So for example, in summertime, we're all at the beach, flip-flops are out, we're having cool drinks, we're having fires with our mates, and then later on in the year it's winter time, where we're all inside huddling, having a fire, having hot chocolates, freezing outside, and then rinse and repeat throughout every single year. How much like we have this example of a reoccurring event or cycle in our lives, there's very similar repeating cycles and events that happen in the markets, such as market valuation cycles, presidential cycles, and many other events that we can use the seasonality forecast to forecast an accurate prediction on where the market may go in the long term based on these true seasonal cycles. Fourthly, we're going to be looking at some of the macroeconomic factors that drives the value of a market, which again we can use to forecast potential moves in the market, such as the gross domestic product of a particular country that drives their currency, the purchasing manager indexes of a particular country, which is a vital economic indicator that signals the health of the manufacturing and services sector based on surveys of purchasing managers in that particular country. Because obviously if manufacturing and the service sector is booming in that particular country, that can increase the strength of that country's particular currency. Retail sales data, which refers to the economic information that measures the total sales of goods and services at a retail level in a particular country. This data is considered a key indicator of consumer spending and economic health, influencing markets like stocks, currencies, commodities, and agriculture. data. The consumer price index of a particular country, which is information from a monthly report that tracks inflation by measuring the average change over time in the prices of a basket of consumer goods and services. Traders, or we as traders, can use this data because it can impact interest rates, currency valuations, and stock market trends, making it a key economic indicator for market analysis and trading directions. Employment changes and unemployment rates in a particular country, which can ultimately drive the value of a currency, because when a particular country's employment is increasing and unemployment is decreasing, that obviously increases the value and the performance and the economy of that overall country. And finally, interest rate data, which refers to the various rates charged for borrowing money or earned on savings and investments. And this data is influenced by a country's central bank and by factors such as the supply and demand for credit and inflation. Different types of rates, such as nominal and real interest rates, provide different measures of the cost of return, which again can depict the value of a particular country's currency. Let's get started with why these fundamental factors are so important in the market. Now, the first thing I want to explain is whenever you're analyzing a particular market on any candlestick chart on your relative trading platform, whether that may be MetaTrader, Bloomberg, the analysis of price, which is the candlesticks that we see, is just a representation of the underlying fundamental condition of a market. So most retail traders who are trying to find these strategies and profitable edges in the market by just analyzing candlestick charts is really just seeing, if I put this in terms of an iceberg, which on the tip of this iceberg is those candlestick charts, which is just surface level, tip of the iceberg, 10% of what is actually going on. So trying to find a profitable edge by analyzing candlestick charts is kind of like trying to understand the entire plot of a movie after you've only watched the first 10 minutes. It's just simply going to be very difficult to find that. Below this entire iceberg is what most traders lack: the deeper understanding of those underlying fundamental and macro drivers of the markets that they trade. So let's go over how to predict these major moves before they happen and how you can master the art of forecasting price. So let's go and break down the different 4 segments of this iceberg we have been talking about. So as we mentioned, on the top of this iceberg is the physical candlestick charts, where we do our analysis and we have our set of technical rules and your particular trading strategy. Underneath this iceberg, which we break down into 3 segments, which will be the commitment of traders reports. These reports will tell us and allow us to follow quote unquote smart money. Market valuation, which we will use cross-market conditions to help us understand whether a market is undervalued or overvalued, which we can then use to our advantage to line that up with our technicals. And finally, true seasonality, identifying dominant seasonal time periods or seasonal reoccurring patterns in the market, which we can use this to forecast and see a relatively accurate futuristic depiction of where the market may go in the longer term. So let's start off with the first underlying fundamental factor, for me, which is kingpin in a particular market. The COT reports, the Commitment of Traders reports, which comes from the Commodity Futures Trading Commission government website, where we can come over to market data and economic analysis, the Commitment of Traders. We can then go and view our different market asset classes, all of the positions that institutions, non-commercials, and retail is in these particular markets. So for example, if I come and click on the financial markets, I can click on long format. It will open up these reports in the form of this rather messy database. So right here at the top, we can see the Canadian dollar, where right now dealer intermediaries, which is our commercial guys, are 118,000 contracts long. Asset managers and institutions are 97,899 contracts short, whereas retail is currently 21,904 contracts long and 31,279 contracts short. So right now, institutions are majority short on the Canadian dollar, while retail is semi-neutral to mildly bearish. So we'll most likely see right now that the Canadian futures or the Canadian dollar futures is a bearish market. Throughout this list, you can view every single major currency from around the world. The COT reports consists of 3 groups of market participants. One is our commercials, which is our users and producers. These are the smartest players in the market that we'll often see hedge against price. And these are the guys that ultimately create the market lows and market highs that we see on the higher time frame. Secondly are our non-commercials, our institutional traders. These are mostly fund managers, banks, and other large traders that generally follow the trend and average into their position sizes. We'll go into that over more detail a little bit later. Thirdly is our retailers, traders like normal people at home that are trading for themselves, individual small traders and potentially smaller investor firms. The reason they are important is because we'll see, as the statistics show now, retailers are simply just wrong 85 to 90% of the time. When retail is very bullish on a market, we often see that market go short. I'm quickly going to go over the objective and the goal of each market participant to help you give you a good understanding of how these markets are moved by these three market participants. So firstly, I'm going to put this here, just like that, is our commercials, which is our institutional traders. Firstly are our commercials, our users and producers, which are the market participants that buy lower prices at weakness and they sell higher prices into strength. So much like any conventional business or firm around the world, they operate in a very similar manner. So what this means is they buy cheap and sell expensive. And the reason these are such an important player in the market, because they are the biggest and the smartest players. These are usually the best analysts on staff that consist of traders of usually at Citadel, your major billion-dollar firms, and these are businesses that rely on buying and selling at advantageous prices. If I had to show you a quick example of this on the live chart, right here is my COT report represented in this blue graph, which represents the market participants of the commercial players, our smartest players in the market. Whenever the commercials are super bullish at market lows in our particular levels, we tend to see those rallies in price. Whenever they go bearish, we tend to see those market bearish runs in price. And based on the information on this particular market, which is the United States dollar futures, right now, the institutions are at a multi-year extreme. So this is where they are right now, towards the end of this year, which is the 2025. They were last this bullish 4 years ago. So this would be a 4-year record bullish extreme from the commercial guys. So we've seen towards the end of this year a strong bullish rally on the dollar. So therefore, knowing that information, we'll see markets such as USD CAD having strong bullish markets at the moment. Our second market participant, and towards the end of this podcast series, I'm going to give you a little bit of a short idea of how I apply these fundamental factors as kind of like a rule-based system, and how you can start to have a look at this type of information to perhaps benefit your edge in the market and start aligning your technicals with these underlying factors. Secondly is our retailers, our non-reportables in the COT reports. What non-reportables mean? Every single week, our reports come in from the institutions and from the commercials, and whatever reports or remaining contracts are left over in the futures markets is what has been traded by the retail traders around the world. And what their objectives are, they are small speculators in the market. They ultimately just try to follow the direction of the market. Extreme buying from retail leads to market tops, and extreme selling leads to market bottoms, and they are just simply wrong most of the time. In an example over here on the right hand side, usually when we see retail traders at a strong bullish extreme, we see those market tops being formed. Here they sold off the market into a strong bearish extreme. We saw that market bottom form, which was a bullish run for an entire month on that market. And again, into a strong buying extreme, forming that beautiful market top, and vice versa throughout the play of this particular market. Just to briefly show you these retail traders in live action in the COT reports and how this correlates to this particular market, which we still will use the United States dollar futures, where when retail is usually at strong selling extremes, I'm just going to put this here with a vertical line. Here's a strong selling extreme. Here was a strong bullish extreme, strong bullish extreme, strong bullish extreme, strong bearish extreme, and again now at a bearish extreme, or really from this low over here. And continuing further back all the way to 2023, strong bullish extreme. At this peak here, again, a strong bearish extreme down here, another strong bearish extreme down here, bullish extreme, and a bullish extreme. And every time we see them at these extremes, the market, almost 10 times out of 10 in the last 3 years has gone the opposite direction for a multi-month bullish or bearish run. And our final, third, and last player in the COT reports and ultimately in the markets is our non-commercials, our institutional guys, which consists of commodity funds, banks, other long-term investment firms such as maybe Sanlam, who offers retirement plans, who are simply firms that just follow the trend and size into their positions. They speculate and they follow the trend. They buy into strength and they sell into weakness. Extreme buying leads to market tops and extreme selling leads to market bottoms. And they are trend followers, very similar to that of retail. To show you an example of the last 5 years or so on the United States dollar of the non-commercials represented by this yellow chart from the COT reports, which is really directly extracted onto my chart, I can now go and view these guys separately. And we'll see whenever the market is bearish, non-commercials are following that trend. When the market is bullish, commercials or non-commercials rather are following that trend. And now one may ask, well, if they are simply just following retail, how come retail is wrong 80% of the time? And kind of makes sense for them to be wrong as well, because they look very similar to retail. Well, keep this in mind. Their objective is completely different to that of retail. Often what we'll see these non-commercials and how they operate is they will often jump and skip positions. So what we'll see is usually a big skip in price like this, where often in these smaller moves, they've already secured their profits on their initial larger buying positions. And as that market continues to up a bit further, they kind of average in with less positions. So even though their top positions here may be at a bit of drawdown when this market comes down, they've already profited from their majority of their positions at the bottom of that move. And very similarly, as market starts to sell off, they will skip positions, making most of their profit from that initial move. And as the trend continues lower, start to average in. And how we can analyze these guys is identify their tops and bottoms, which creates market tops and bottoms. So whenever non-commercials are at bullish extremes and vice versa at bearish extremes, we tend to see those market lows. And at those bullish extremes, those market highs. Right now, the non-commercials are also at a multi-year, I think close now to 4 years, bearish extreme, which as we know, their lows create market lows, or playing a factor in the current strength increase on the United States dollar. All right, so that is really the full cover of COT, the major market participants, how they operate, and how you can use that to your understanding to potentially forecast those next big market moves. Let's dive into the second section of this podcast, where we're going to now talk about market valuation, which is ultimately presented in the form of this graph chart over here. So I don't like to call these indicators because indicators are usually lagging tools that look at past market information. These tools over here are ultimately live feeds. So this indicator reads the exact live valuation against that economic powerhouse of the world that I mentioned, represented by these three graphs, as well as COT reports. That reports tool is a direct live extraction feed from the CFTC database. When those reports are updated every single Friday, that same indicator extracts those new reports and updates live automatically. All right, so let's quickly dive into a bit of an example of valuation, how we use it on a particular currency pair. So I'm just going to use a position I was in on CAD in the beginning of September. And always keep this in mind. When we're looking at any particular currency pair, whether that's the currencies of the world, even stock market, as well as the Bitcoin market. In this example, this is the market of the Australian dollar currency versus the Canadian dollar. So this will be the CAD market. Now, always keep in mind, in a currency pair, there is essentially two assets or two currencies in this market. So this particular market is the direct value of the Australian dollar versus the Canadian dollar, which equals and will give you the CAD currency or market. So what we need to go and do is we need to go and dissect these two currencies. And what we'll do is we will value the front currency against that back currency. So on my valuation settings, this being the CAD market, I will then go and value the Australian dollar against the Canadian dollar. So if I now enable this, I can actually disable my symbol 2 and 3, which is the gold market and the treasury bonds. Reason being is because we value various different asset classes against different markets. So currencies, we cross value against each other. So if we're looking at the pound yen, GBP, JPY, we will value the pound separately to the Japanese yen. If we're looking at United States stocks, the most important factor that plays a role in those market highs and lows is the valuation against the United States treasury bonds. If we're looking at finite markets, which is mostly our commodities, agriculture markets such as gold, silver, reason they are finite, these are markets that do not run out of resource. So for example, we can't mine unlimited silver, or we can't farm unlimited wheat or cotton. So those markets we value against the gold market, which is the leading finite and commodity market. So in this example of ORD-CAD, again, if I use my horizontal line, every time we see the Australian dollar undervalued or overvalued to the Canadian dollar at these valuation extremes, we tend to see those strong corrections in price. Right, so here we were overvalued. Again, we were overvalued at this top, undervalued over here, overvalued at this top, undervalued at this bottom. And just going through this information from February to where we are now this year, the last 2 times we were strongly overvalued, we saw nice market highs come in. Remember, this is the daily time frame. So from this high, we saw a 1, 2, 3, 4, 5, 6 day bearish run. From this overvaluation extreme, we saw a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 day bearish run. From up top, this valuation extreme, we saw a 4-day bearish run. Overvalued extreme from the 13th of May, we saw a multi-month bearish run. Really, from the end of Feb to the beginning of March, we saw an overvalued top, which again led to a multi-week strong bearish run. Undervalued, in the beginning of Feb, we saw a multi-month or multi-week bullish run. So the idea behind valuation is when you're in any particular level, whether you trade support resistance, trend lines, supply demand, whatever you're using, a really nice confluence for your positions is to have that particular currency, the front currency, if you're looking for longs, undervalued to the back currency, which acts as a really good odds enhancer for your particular position. If I go and have a look at Bitcoin, so Bitcoin is a market that we value against the United States dollar. So a big player in the potential, we could say, quote unquote, Bitcoin crash. I'm not really going to call it a crash. It's just really a bearish run that is due. As we can see, when this bearish run started, we were the first time overvalued this year since April this year. So it was the first time we've been overvalued in nearly 7-8 months. And we saw right at the top of that valuation extreme, that market top. We then came into undervalued. On the 20th of October, we saw about a week strong bullish run. Again, we are undervalued at the moment, but we have yet to see that valuation move kick in. So what we will most likely see on Bitcoin is potentially a bit of a correctional move before maybe continuing bearish. Reason being is because the COT reports are strongly bearish biased at the moment. Commercials, our smart players, are shorting off their positions, while retail is remaining bullish in Bitcoin. Beautiful sentiment to continue short for now. I will use one more example of the stock markets. Let's take, for example, the NASDAQ, the top 100 share value of the top 100 companies in the United States. So NASDAQ being a stock, this is ultimately driven by the treasury bonds valuation, which is by default my symbol 3. And similarly here, whenever we see those overvaluation extremes, we like to see those market tops. This was the first time we were overvalued on NASDAQ since May this year. The last time we were overvalued, we hardly saw bearish correctional runs over here, right at this peak, this peak, and this peak. Reason being is because COT reports at that time were very strongly bullish. Right now on the NASDAQ, COT reports have gone slightly or more bearish sentiment. So knowing that information and aligning the valuation with the COT reports, much better sentiment to see a bearish run from this overvaluation extreme. Right now, we are strongly undervalued to treasury bonds, and we really now see on NASDAQ today a rally from about 24,300 to nearly 25 1,000. So who knows, maybe this rally will continue. I will continue to follow the COT reports. Again, NASDAQ, Dow Jones are usually markets I prefer to invest into rather than to trade, as these markets have personally been some of my best performance throughout the last couple of years. And again, very similar rule when you're coming into your level, whether that be supply demand, maybe a trend line touch or breakout, whatever perhaps technical concept that you're trading, you ideally want to be, if you're looking for longs, undervalued to treasury bonds in your particular level is a really good confluence to continue long with your position. Thirdly, our true seasonality forecast cycles. So as I explained, much like we have those reoccurring cycles in our human year-to-year lives, very similarly in the markets, we see reoccurring cycles, patterns, and events, whether that be presidential cycles, election cycles, municipal cycles, valuation cycles. This tool is able to take all of the information, read all of the past market cycles, and predict quite a strong, accurate forecast on potentially where the market is going to go in the longer term. So I'm going to go over an example of an Ethereum long that I took towards the 4th of November this month, where we had a valid technical level within my technical rules that we can cover in a separate podcast, maybe in a second episode. But for now, I just want you to grasp the concept of seasonal cycles. So really just to kind of put this into perspective, coming into this position or this long zone where I had my long limit set for a 2 risk to reward, really what I could see is on the short-term forecast and the long-term forecast, which is set to a 10-year seasonal cycle forecast, my bottom tool set to a 15-year seasonal cycle forecast. Usually what I like to do is I like to put a horizontal line on my limit or where I'm about to get tagged in and put a futuristic line in the future in a month from now. And I can see on Ethereum, really for that particular month, we forecasted a strong bullish market for the next month from really beginning of November to end of November, which hasn't really kicked in yet. So far, this move has been smaller than the forecast, and there's going to be times where that's going to happen. The forecast is not always going to be 100% timing tool. There's going to be times where the move happens before the forecast is forecasting, or where the move happens later than what the forecast, or where the move is not as big as what the forecast is anticipating, or where the move is bigger than what the forecast is anticipating. But in general, it's a really great odds enhancer and confluence to your setup. So if we come over to the Australian dollar, how we would use this particular forecast is right now on the Aussie dollar, really from the area of September, end of September, we kind of forecasted a strong bearish dip in the market. And here's an example of where the forecast kicked in beautifully. So as we got to these tops, right here, right here, right here, we forecasted those bearish moves quite nicely. And right up here, we forecasted a strong drop in price, where we've now seen the last 2-3 months, a strong bearish run on the Australian dollar versus the US dollar. What we're forecasting now for the next month is a bit of a drop, really from where we are in November now to the beginning of December, a strong drop in price, which so far the forecast is following quite keen. From mid-December onwards to New Year's, we are forecasting a strong bullish rally on the Australian dollar. So how we want to use the seasonal forecast is really in alignment with the valuation and COT. So for example, if we're coming into a really good supply or demand zone, let's take a demand zone for longs, for example. Forecast is showing beautiful bullishness from the zone. We undervalued. COT reports are bullish. Bias, commercials are bullish. Retail is bearish. That is an A+ setup scenario. Personally, for me, seasonality forecast is more an odds enhancer for your setup, not really a primary fundamental factor for a market, but it is a great confluence to have. My favorite two, or most important two fundamental factors, is COT reports and ultimately valuation. So before we dive into how we can kind of analyze the macroeconomics of a market, I'm just going to go over one example of all of our rules put together on a recent Aussie dollar Swiss franc short position that I took on the 3rd of November. In terms of my technicals, again, that's not so important right now, but for me, a really good A+ supply zone resting at about the 9th of October. Really strong leg in, indecisive base, strong leg out from the preferred level of that particular supply zone. In other words, a valid zone for me to consider shorts from, pending that my fundamental rules are aligned from this zone. So if I mark out a vertical line from the point of tap-in on the 3rd of November, coming over to market valuation, which is the first fundamental factor I look at, valuating the Aussie dollar against the Swiss franc from the point of tap-in on the 3rd of November, beautifully, Aussie dollar was beautifully overvalued to the Swiss franc. Really good confluence for our zone, purely because we know the Aussie dollar has to revalue against that Swiss franc. Where you can see we are from right now, strongly undervalued, seeing that recorrection in price for the market to revalue. So first things first, valuation was aligned. That's a simple check on the list for me, which is ultimately a must-have for my zones. In terms of seasonal forecast, from where we got tagged in to about a month from now, which is the 5th of November to the 5th of December, we can see generally on the 10-year and 15-year a strong bearish forecast from the supply zone, as well as on the 10-year a relatively strong bearish run between the month of November to the beginning of December. So forecast beautifully aligned. Simple check on both of these. So far, all stars are aligned. And then coming over to our COT reports, I can see that our commercial participants in the market went extremely bearish on the Aussie into a 1-year bearish extreme. So commercials definitely sold off their positions on the Aussie dollar, while retail maintained strong bullish positions. Very strong sentiment for this market to go short. If I zoom into my retail guys, all right, they remained strongly bullish on their positions in the Aussie market. Very good sentiment. All stars aligned for shorts on this market. We have our valuation aligned, seasonal forecast aligned from the zone. COT reports are definitely bearish on the Aussie dollar. All stars aligned to go short on this position. The last and final section of this podcast series is to go over how we can read the macroeconomic information on a particular country. So this is really an institutional screener, or you could say third-party terminal that I use to access this information. So coming from a Bloomberg background, I moved to something like this just because it extracts the information much more cleanly, making it much easier to read compared to a platform like Bloomberg. So one of my favorite features of this terminal is that I can come over to economic heat maps and I can go and view the economic strength or weakness of a major currency in the world. So for example, I can click on the US economic heat map and I can go and view all of the economic data in the United States, such as GDP growth, manufacturing PMIs, services PMIs, retail PMIs, CPI, PPI, PCE, wage growths, unemployment rates, job loss claims, JOLTS, job openings, non-farm payrolls, ADP, non-farm payrolls, and then can kind of view if these particular different segments in the US economic data is favored for bullishness, strength, or bearishness, aka weakness on the dollar. So right now, the US dollar currency is really neutral, meaning the US economy is generally neutral at the moment. However, US economy sentiment, which is our COT reports, is predominantly bullish at the moment. And in terms of stocks, the US economy favors strength on the stock markets, meaning we ideally want to be undervalued, looking for longs on our stock markets. On the Canadian economy, for example, right now, most macroeconomic factors are favoring a strong Canadian dollar. I can view all of the COT data in one simple table, really ranked from the most bullish future pairs at the moment to the most bearish future pairs at the moment. So, for example, institutions are strongly short on the Australian dollar for the last couple of weeks, maybe even a month or two, while the institutions have been strongly bullish on the United States dollar. So we'll most likely see a market such as the Australian dollar versus the US dollar, which would be our AUD/USD market, strongly bearish the last couple of months or last couple of weeks. And like we've really seen over here, really since 16th September, mid-September, we've seen a nice weak Australian dollar because institutions are shorting the Aussie while they're buying the United States dollar at the same time, which would naturally create a bearish market on AUD/USD. So knowing this information, I want to be overvalued in my supply zones, looking for shorts. I can also go and view specific information on separate currency pairs on their own. So for example, if I go and have a look at GBP CAD, which is predominantly a very weak currency at the moment, mostly just bearish in terms of fundamentals and macroeconomics. So knowing the fact that their employment rates have dropped, in the UK. Unemployment has increased in the UK. PMI services have decreased. Interest rates have decreased. Retail is strongly bullish on the pound CAD, which is all strongly sentimented to bearishness on the pound CAD. So if I come over to the pound CAD, we've seen really since the beginning of October a strong bearish market. So again, we know we want to be shorting off our supply zones further back, seeing this economic weakness coming into the supply zone. And factors such as COT, if they are bearish, if we are overvalued, all extra great confluences to align with this bearish economic information. If you guys enjoyed this educational podcast video, make sure to pop a message in the Ouinex Telegram group. Get active, get engaged there. You're welcome to post topic ideas or potential market forecasts on markets that you would like me to forecast for you in future podcasts. Put some ideas or markets that you potentially want me to go over in the Ouinex Telegram group. With that being said, guys, hope you got some good value, and we'll see you in the next podcast series.